Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 23rd of September 2018, and we're providing a brief description and analysis of the Commitment of Traders Report, or COT Report, Part 2. In Part 1, we stated that COT stands for Commitment of Traders Reports, and is published by the Commodity Futures Trading Commission, or CFTC, on Friday afternoon, based on data gathered at the close of business the preceding Tuesday. Specifically, the COT reports provide a breakdown of each Tuesday's open interest for futures and options on future markets. The data is gathered at the close of business on a Tuesday and is published on Friday afternoon. This report, that is the disaggregated COT, was first published on the 4th of September 2009 and increases transparency by separating traders into the following four categories. 1. Producer, merchant, processor, user, so producers or users of the product. 2. Swap dealers. 3. Managed money, or speculators. And 4. Other reportables, which tend to be smaller traders. We shall limit our analysis to producers, managed money, and other reportables. We have also pointed out that reports also use slightly different terms, which are commercials, that's the producers' users, the non-commercials, the speculators, e.g. hedge funds, and the non-reportables, basically small traders. We also pointed out that a futures contract is a derivative which gets its value from an underlying asset. They are traded to either profit from future values of the asset, which is essentially what managed money or non-commercials do, or to hedge a position in the asset against a drop in price, which is what producers or commercials undertake. Okay, having provided this brief recap, we thought it appropriate, especially for those new to trading, to give a few more definitions. A long contract is one taking out expecting prices to rise, and a short contract is one taken out expecting prices to fall. And a spread means the extent to which a non-commercial or producer user holds equal long and short positions. Now for a tip. Tip number 1. Generally, a commercial or producer normally goes long or short in order to hedge their position. So their contracts generally are in the opposite direction to which price rests. That is, if prices fall, they go long. If prices rise, they go short. A non-commercial or managed money, that is speculators, tend to follow the trend. When prices rise, they go long, and when prices fall, they go short. Now, this isn't always the case, but there is a pattern here. And as we shall show you in a moment, generally, commercials and non-commercials tend to have opposite paths. Now for tip number 2. If hedgers keep increasing their long positions, while speculators increase their short positions, a market bottom could be in sight. If hedgers keep adding more short positions, while speculators keep adding more long positions, a market top could occur. Now, these are not set in stone, but one generally finds that this is the case a little time after these events happen. Maybe days, maybe weeks, or a couple of months. But generally, it gives an indication. We shall now actually take a look at the actual report. So, the first thing we do is go over to the cftc.gov website, which you can see at the top of the page here. Having done that, we click on Market Data Analysis and the Commitment of Traders. We scroll down here and we look for reports dated 18th of September, current disaggregated reports. We look at metals and we click on the short format. And immediately the file comes up, or the report comes up. And as you can see at the top of the report, as of 18th of September. Now we're particularly interested, this is covering all of the metals, palladium, platinum, gold and silver. So we shall go straight to the silver section here, and hopefully I can enlarge this accordingly so that it fits more or less within the screen. And we can immediately see here the 4 different types of trader. Up here on the top left, producer, merchant, user, otherwise known in the other abbreviated form as the commercials. Remember, these are the people who generally take out contracts to hedge their bets. So if they are fearful, obviously, if the market prices rise and they're fearful it may fall, they will take out contracts to protect themselves and vice versa. Swap dealers, we won't be dealing with these at the moment. That comes at a later stage. Managed money here, these are essentially the speculators or the non-commercials. Some call them the smart money. And then we have other reportables here, and other reportables are the smaller traders, and some disparagingly call the dumb money. So let's take a look. What happened last Tuesday? Well, at the end of business, the commercials or producer merchants had 21,000 long contracts outstanding and 32,000 short contracts outstanding. The one I want us to pay particular attention to are the managed money or speculators, who have 52,000 long contracts outstanding, but 99,000 shorts, double. Now, bearing in mind, we've already mentioned that generally the smart money tends to follow the trend, then the indication here is perhaps they feel the market is still going lower, and that is why they have taken out a disproportionate number of shorts. And then coming over to the other reportables, or pardon the expression, dumb money, 27,000 long and 6,000 short. There is a sort of comment in the marketplace, whatever the other reportables are doing, you should do the opposite. Now, the changes from the previous week on the commercials, 1,300 extra long contracts, but 1,900 extra shorts. As far as the managed money are concerned, 738 less contracts long and 2,000 less contracts short. And the dumb money, or I better start call it other reportables, minus 330 less long and 896 less short. Just to add a little bit of commentary on why they're called the dumb money, it's simply because historically these traders have in excess of 80% failure rates. Okay, let's have a look at gold. And as we can see here, producer merchants 29,000 contracts long, 68,000 contracts short. That's just to hedge their position to protect themselves. The one for us to consider, the managed money or speculators, 97,000 long and 180,000 short. And the other reportables, look at this, 99,000 long, if I can click on it, and 28,000 short. 3.5 times more. Quite an interesting statistic. We now move over for a different presentation on the same subject to barchart.com, futures commitment of traders. If we notice here on the right-hand side, we have metals, gold, silver, palladium. Let's click on silver. And now we have this chart here. Now, this is important. This chart, if you look right at the very bottom, runs from November 2015 to September 2018. And it's a weekly chart. And what we're going to look at is essentially this section here, where my pointer is. Let's enlarge it so you can see. And you'll notice the two descriptions. This is the one where we mention large speculators, small speculators, commercials. And the bottom one refers to the COT report we just looked at, producers, swap dealers, managed money, and other reportables. For the sake of this chart, to make it easier, we'll use the top one as it's dealing with three types of trader. Now, let's just have a look here. So I shall remove that one accordingly. Now, a few points for you to notice. The first is the green line represents the large speculators. And you will see generally here the speculators have been positive and then became bearish and operated in bearish territory for really since January of 18. Now that is indicative of what has been happening to the price. They are chasing the trend. The commercials who hedge their bets, as you can see here, have been relatively marginally bearish, then became marginally bullish as the speculators became bearish, then became bearish as the speculators became a little bullish. And if we notice towards the end here of this trend line, you can see the two have not only diverged but crossed one another. So you now have a situation whereby the actual commercials are going long and the non-commercials or speculators have gone short. Now, the wider that gap becomes, arguably, it is deemed that a change in direction will occur. Now, how wide that gap has to be, that is the matter for debate. But let's just have a look what's happened when that's occurred before. If you notice here, for example, the wide gap here has resulted in a high price trend, which as that gap narrowed then fell. And as that gap increased, rose again. And as that gap narrowed, fell. And as that gap increased, rose again. And as that gap narrowed, fell. And it has fallen now all the way down here. Now the general consensus is this indicates a potential reversal of the trend. Now whether that will happen or not, it's not set in stone. But it does give one an indication. Certainly from a chartist point of view, they will say, well, the natural tendency now will be for the price to go up. And it's interesting that silver's at $14. It's risen to $14.30 or near to that level. And traders this week are talking about potentially it could go up to $15. We shall see. However, bear in mind, the large specs chase the trend and they're going down. The commercials hedge their bets. They're going long. So the wider that gap becomes, the greater the potential for the reversal of trend. And that is very important. If we look at the 5-year chart, you can see the same situation. The wider the gap, we have price spikes here. The narrower, price falls. Price has fallen, but then a trend, arguably, if that gap widens in this direction, then we will have a trend reversal. If we have a quick look at gold, 3-year chart, you'll again see the gap there, price peak, then it falls. Gap here, price peaks, then it falls. Gap here, price peaks, then it falls. And again, as with silver, you now have this crossover, albeit slightly more gradual here, which could arguably indicate a change, depending on how that chart bears out. Very similar in gold to silver, very similar indeed, which really supports what we've been saying all along. The trend at the moment is essentially, to be candid, gold leads the way and silver follows. But as we all know, that silver being a much smaller market, if the market rises, then the gearing or the leverage increases, and so silver is likely to rise proportionally more. And if the market falls, it falls proportionally more. Hope that gives you a good indication. It's a very superficial analysis, but hopefully gives you a good indication of what's occurring. We certainly hope you found that useful, and we cannot overemphasize that the COT report and its analysis must be used as a tool, as opposed to necessarily being an absolute blueprint as to what's going to happen to commodity prices. Having said that, there's an interesting book written by Larry Williams entitled Trade Stocks Commodities with the Insiders, Secrets of the COT Report. Now, we own this book, and we have to say it's a little heavy going, admittedly, but it does provide some absolutely excellent tips, guides, and strategies when using the COT report. And if you can afford the price, it's not cheap. It is available on Amazon. It's not cheap, but if you can afford the price, it's well worth it. We put a link below, and in the interest of transparency, we will earn a small commission. We think it'll be somewhere in the region of 2.5% to 5% of the purchase price, so you're looking somewhere between $1 and $2. Not a huge sum of money, but every little helps towards the channel. But more importantly than that, we will only recommend books or courses that we believe can make a great contribution to your knowledge. Hope you found it useful. There will be further, more in-depth detail and strategies about the COT report within the Inner Sanctum when it is launched. But meanwhile, as my American friends frequently say, have a great day. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on Twitter. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe as a free member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.